While everyone is glued to the 1 minute chart waiting for a God candle, the real story is happening in the bond markets and the structural liquidity flows of major institutions. Most retail traders are obsessed with the price today, but the smart money is positioning for a timeline that extends far beyond the current quarter. If you are wondering why we have not shattered the all-time high with conviction yet, the answer is not in the news headlines. It is hidden in the realized capitalization data and the maturation of the market cycle itself. We are looking at a fundamental shift in how Bitcoin is repriced, and this is a signal we have not seen since late 2020. Welcome to the deep dive. Let us look under the hood at what I call the 2026 battleground. The narrative regarding $100,000 per Bitcoin has become a psychological prison for many investors. Everyone assumes it is an inevitable checkpoint that we will cross simply because the halving occurred. However, the reality is much simpler and far more brutal. $100,000 is not just a round number. It represents a valuation where Bitcoin begins to compete directly with mid-sized global currencies and major commodities solely on a liquid basis. To get there and stay there requires a level of sustained inflow that retail traders simply cannot provide. We are moving from a speculation-driven market to an allocation-driven market. This is the kicker that most people miss. In previous cycles, price discovery was driven by high leverage and massive volatility on unregulated offshore exchanges. Today, the price is being dictated by spot purchasing from entities that do not care about the daily close. They care about quarterly rebalancing and risk-adjusted returns over a 3 to 5 year horizon. This changes the velocity of the move. Instead of a vertical lineup, we are seeing a grinding, suffocating range that forces impatient capital to exit. This is what we call time capitulation. Price capitulation is quick and violent, but time capitulation bleeds you out slowly by doing absolutely nothing while you pay funding fees. The data supports this view when we look at the short-term holder cost basis. Every time price dips below this metric, we see panic selling from entrants who bought in the last 3 months. Yet, simultaneously, the balance on over-the-counter desks is drying up. This divergence tells us that while tourists are leaving, the residents are buying the real estate. The exchange-traded funds have created a permanent bid, but they have also dampened the volatility. They act as a buffer. They prevent the price from crashing 40% in a day, but they also create a massive wall of sell orders as we approach key resistance levels. This brings us to the core of the 2026 thesis. Why 2026? Historically, we expect the cycle peak to occur roughly 12 to 18 months after the halving. That would put the theoretical top somewhere in late 2025. However, the introduction of institutional capital tends to lengthen cycles. We saw this in the equities market over the last century. As an asset class matures, the cycles become less explosive and more drawn out. We are likely transitioning from a 4 year cycle to a broader secular trend that aligns with global liquidity cycles, rather than just the code of the Bitcoin protocol. The battle of 2026 will not be about reaching a peak. It will be about defending the new floor. If we hit $150,000 in 2025, 2026 becomes the year where the market decides if that price is real value or just a speculative overshoot. If this breakdown is helping you navigate the noise and keep your emotions in check, consider joining our community with a subscribe. We focus on the data that moves markets, not the hype that drains wallets. Let us draw a historical parallel to understand the structure we are building. Look back at 2016. It was a slow, painful grind upward that bored the majority of traders to death before the parabolic run of 2017. Most people remember the vertical move at the end, but they forget the year of consolidation that built the base for it. We are seeing a similar pattern now, but on a much larger scale with much more capital involved. The difference this time is the leverage ratio. In previous cycles, open interest would wipe out billions in minutes. Now, because the spot market is dominant, the leverage flushes are less systemic. This is healthy, but it makes the price action feel sluggish. You need to adjust your expectations for speed. The days of doing a 10 times return in a month are likely behind us for major assets. We are entering the era of compounding returns, which is how real wealth is built. Now let us talk about the specific downside risks that nobody wants to discuss. The biggest threat to the $100,000 thesis is not a crypto ban or a hack. It is a liquidity shock in the traditional financial system. If the bond market breaks, or we see a resurgence of inflation that forces central banks to tighten again, risk assets will correlate to the downside. Bitcoin is becoming more integrated with the global financial system, not less. That means when the stock market sneezes, crypto catches a cold. However, here's the silver lining. In that scenario, Bitcoin eventually decouples as a sovereign store of value. But the initial shock would be severe. This is why looking at the 2026 horizon is critical. By then, the macroeconomic environment is projected to stabilize with lower interest rates globally. That creates the perfect storm for the next leg up. So, what is the playbook for this environment? First, you must stop leveraging your long positions at resistance levels. The market makers know where your liquidation price is. They will hunt it. The strategy right now is spot accumulation during periods of low volatility. When the Bollinger Bands tighten and everyone on social media is complaining that the market is dead, that is your signal. You want to be the liquidity provider when others are demanding liquidity. Second, you need to watch the dominance chart. Bitcoin usually leads the charge. It breaks the all-time high first, sucks the liquidity out of the rest of the market, and then stabilizes. Only then does capital rotate into high beta assets. If you try to front-run this rotation too early, you will underperform the benchmark. The 2026 battle will be fought by institutions who are legally mandated to hold a percentage of their portfolio in digital assets. We are already seeing pension funds and state treasuries dipping their toes in. By 2026, this will not be a test. It will be a standard operating procedure. Imagine the buying pressure when every sovereign wealth fund allocates just 1%. The supply shock will be mathematically undeniable. But the market will try to shake you out before that happens. It will test your conviction with jagged price action and false breakouts. The most dangerous thing you can do right now is overtrade. Most investors give back their entire year of gains in 2 weeks of bad trading during a chop zone. Sit on your hands, let the thesis play out. The chart that matters most right now is the monthly time frame. Everything else is just noise designed to separate you from your position. We are building a structural base that can support a multi-trillion-dollar asset class. You cannot build a skyscraper on a foundation of sand. This consolidation, as painful as it is the concrete pouring phase. If you found value in this deep dive, a like helps the algorithm share this data with more serious investors who need to hear it. We need more rational analysis in this space and fewer emotional reactions. Finally, remember that none of this is financial advice. I am looking at the data and sharing my strategy, but you must do your own due diligence. Markets involve risk, and you should never invest money you cannot afford to lose. The road to 2026 is paved with opportunity, but only for those with the patience to walk it. Stay sharp.